Hi, I'm Phil Anderson and welcome to my channel. I've been a property investor now for over 30 years and I've watched investors continue to make the same common investment mistakes. There's so many dirty tricks in the real estate industry and it's all caught up in a whole heap of sales hype. I want to cut through that sales hype and help investors avoid the common mistakes. I hope you enjoy the following content, but please remember to like and subscribe. Hey listeners and viewers across the country, welcome to another episode of Street Smart Property Investing. I'm joined again today by Mr. Trent Durrington.
Phil.
How are you, Durro?
Good to be here, mate. Good.
Good to have you. Look, guys, we've got something really important to talk about today. The banks are slashing interest rates. They're starting to open things up for property investors, and I wanted to make sure that all the investors understood what's happening in the market, because I think a lot of people are sitting on interest rates they shouldn't be paying, and it really is time to get buyer ready and take advantage of these interest rates. But we've got a number of concerns that come hand in hand with that, and we're going to touch on a few of those today. Let's just take a step backwards a couple of years though. Mate, 2017, Banking Royal Commission, APRA starts looking into, lending criteria, everything started to fold through 2018. Hardly any investors were able to get loans. We really saw a retraction of investors in the market.
That was investors and owner-occupiers.
And owner-occupiers, right? But investors, because we're so exposed to that world, we saw it like a cliff. Really did. 2019, we had hopes that common sense would prevail. Still great conditions for a property investor, a lot of need for property. Interest rates were relatively good. We thought they were really, really good at the time. They look back now and they were obviously not as good as today.
Government certainty.
Lots of stuff, right? It was a really solid market, but then we had the federal election. Of course, there was a strong chance we're going to have a change of government. There's a lot of talk about a change to the negative gearing laws, which freaked a lot of investors out. A lot of people were really concerned about the policies we were hearing about.
Well, at that time, I remember us basically accepting that there was going to be a change of government.
Mate, look,
and we were just
inevitable.
We were strategizing. Okay, well, it's going to happen. There's got to be some positives potentially that come of it. What are they?
Yeah.
So when the election didn't happen or Labor didn't get in, the momentum then took a little while to get going again. People went, geez, what does this mean? You know? So it took a little while for that confidence to get back in.
Yeah. And you know what? The interesting thing that came out of that election, one real big takeaway I got from that was John Howard interview that night. And he mentioned that, the Labor policies about negative gearing and abolishing negative gearing and trying to get back, sort of a bit of power for the small guy, et cetera, whatever that was, help working class Australia. And Johnny Howard pointed out that a lot of Australians that work hard, save hard, buy a family home and maybe buy themselves an investment property to try to help them, set up their retirement years. They're not the big end of town. They're the average mum and dad. They're the people that don't need to hear about changes to negative gearing laws. They need certainty in their world. And I thought that was a really good perception of why it all turned on the Labor government when that happened. But we're talking politics. We never should talk politics.
No.
But anyway,
you just touch on that. It's Johnny Howard did have it's a good interview. But that's the bulk of our clients too that are workers.
Mate, average people, right?
Yeah, average that work hard, trying to increase their portfolios with the end in mind.
Absolutely.
And anyway, it went the right way.
Yeah, well, mate, look, what we saw and what we've experienced since 2019 all pointed towards 2020 would be a breakthrough year where property investors would come back into the market. Everything. There was no logic as to why we wouldn't see a surge in property investors entering the market in 2020. But of course, none of us picked COVID. COVID hit the market by April. We're all going, how bad is this going to get? A lot of, the people that follow our content were asking me, what do I think's going to happen? And like many others, I said, look, brace yourself. This could be bad, right? This is something I've never seen before. You know, a lot of people that follow my research and so forth, they know that I got quite aggressive as a buyer through the GFC. I'd read most of those cycles. I thought they were ideal opportunities to buy, not to sit it out. But I didn't know how to pick COVID. You know, I don't think anyone could have. But by, I don't know, even 3 months later, June, July, we were like, wow, this is starting to turn in our favour. The model that we've been following, our focus on regional Australia, everything about it started to really turn in favour of in property investors that weren't so emotional, ones that were using numbers and so forth.
Yeah.
But unfortunately, by the end of 2020, so much of that emphasis really did roll towards the advantaging the home buyers. And that's what we've seen of late. It's been a home buyers market. It's a home buyers boom, right? It's not an investor boom, it's a home buyers boom.
Yeah. Well, I mean, there's lots of layers to that based on the areas that we liked purely for numbers. But the areas that we've liked, you know, call it regional, and a lot of those areas are, you know, coastal. Magnificent, beautiful places to live. So, although the numbers have stacked, they are also just beautiful places to live. So then you had people wanting to move there, people that would typically move to the big cities as they get older, or career-wise are not moving out of the regions. So it's been exciting for the areas that we've targeted. And the growth they've had.
Now, most of those areas were already preparing for growth. They knew that the baby boomers were going to flow that way. Government research, government investment, local investment, everything was gearing up for population growth. But, you know, totally underestimated how quickly it was going to come because of COVID. And it hasn't been the baby boomers. There's been some of that. I think there's still plenty more of that to come. But, you know, the remote workforce that's now spilling out of Sydney and Melbourne and moving into those regionals. And when we say regionals, the big mistake that a lot of people would have made in the past is thinking of regionals as being little country towns. These are, you know, secondary cities really within the states.
80,000 people.
Universities, hospitals, airports, etc., etc.
Yeah.
But they are absolutely on fire at the moment. And the reason why I thought today's topic was really relevant is because this month, it's really been a breakthrough month where I'm now starting to see the banks add fuel to the investor lending and investor market, getting them even more inspired to get back in and compete for properties, because they do have to compete with home buyers. But there's this change in the chapter where now the investors are going to start out-muscling the first home buyers. I think the affordability factors and a range of other elements are going to see investors start to potentially overshadow that first home buyer market. Of course, you know, we both know, and this is the scary thing that you keep pointing out to me, you know, it's great to see investors coming back. It's great to see the banks starting. We'll talk a bit about interest rates and what the listeners should be looking for and should be expecting. But it's great to see all of those facets fueling this desire for investors to get back into the market. But you're really concerned about what stock is out there for them to purchase.
Yeah, no. Well, there's still regardless of the home builder grant, there's still a residual of buyers, owner-occupier buyers, still trying to find, the right properties in the right markets. Conversation I had last night was on a really nice estate in the Sunshine Coast, 180 buyers for 27 blocks that are being released. So, you know, it's still driving, and that's across Australia. So, 100% investors are coming back in droves, but it's you still got to be careful of finding the right property in the right area.
And so much has changed, even in that same period of time we just described. Since the last federal election, one of the things that did happen was, the government did want to appease some of that, desire to change the negative gearing laws, and they did put in place a change to negative gearing laws, which really did start to, more than ever before, favour brand new properties over old properties. That change of benefits, the stuff that we look for to make the numbers really work well, and that's depreciation benefits and so forth, really widen the gap between whether you would pick an existing property or a brand new property. So many investors now that understand that detail and understand how to make the numbers work best, they really do need to buy brand new. Now, buying brand new at the moment, that requires land, right? The suppliers of that sort of property typically has access to that land. They typically can say, yep, we'll take a dozen in this next stage. They've got options to buy, and then they just appoint them to their investors and so forth. But none of that's happening at the moment. They can't get access to the land.
No, that's what's surprising is that the quality estates are accepting zero investment. Typically, on a quality estate, you could have investment up as high as 25-30%, and that mix is fine, but zero investment.
And we're talking major players, the building companies that have been the backbone for these land developers, helping them have confidence about turning the dirt, providing these new lots of land and so forth, and underpinning, I guess, a bit of that confidence through saying, yep, we'll guarantee we'll take 30% of the land or whatever that may be. Today, the land developers are not even interested in giving them access to the land because they've got an oversupply of owner-occupiers that want that land and will pay premium for it.
Yeah, in many instances now, you've mentioned it before, the ballot system, lottery,
even auctions, mate.
Auctions, yeah, the auctions was a good one.
Who would have ever thought that we would see land that's being developed, maybe still 6 months from being completed, being auctioned? It's crazy.
Yeah, online live auctions. So, the buyers are seeing where the price is, but them setting the bar of what they think that land's worth and buying unconditional land, sometimes further than 6 months out from registration.
Yeah, so it's important to touch on that because as we see buyers have more access to finance, as we see, investors have more access to finance and that lending criteria get better, the banks start to free up and allocate and have more appetite to support the lenders, the investors looking to borrow funds. Your biggest concern, and mine, is obviously the quality of what stock they can actually secure.
Access,
yeah. Let's talk a couple of numbers though, just so we can give the listeners some stuff to think about. Interest rates, it's really interesting because National Australia Bank, that have recently slashed in the last week or so, slashed interest rates for investors. They're the lowest of the big four, and you might be really surprised to know that they've cut their variable principal and interest loans to just 2.79%. Now, under 3% for an investment loan, I would never have thought possible.
It's a good podcast we're having here because I know myself it's a reminder to get back to my banks and say,
we're all guilty of it.
Am I paying the best rate? And I guarantee in the next day or two when I have that conversation, I won't be paying the best rate.
No.
So for our listeners, it is important that you're constantly on your bank, your lender. Getting the very best rate, and if you need to refinance.
It's a big factor. I'll tell you an example of someone that's just run these numbers because it'll stagger you. But outside of the big four, and National Australia Bank, like I said, they've got the best rate there at the moment amongst the big four. Heritage Bank, they slashed up to 50% off their principal and interest mortgage rates, and they're a little under 2.29 for a crazy product. The lowest, it's an interesting one. It's actually a local owned bank in the inland market of New South Wales, in Tamworth and other sort of inland hubs. But the Northern Inland Credit Union's got a variable interest rate of just 1.89% for investors. Bizarre, right? It's just amazing stuff. Now, one of the reasons why I thought it was worth sharing, and it's not all the same, because if you look at, I know there's a chart that I picked out for this particular podcast, 25 different lenders. 19 of those lenders have chosen to cut interest rates for investors, but 6 out of the 25 have actually increased rates for investors. So everyone's going to have a slightly different appetite. Now, I think most investors don't realise, because they stay true to one particular lender, and you and I know that you should really use a broker and try to understand what other products are out there. But some banks don't have the same appetite as others. Some are lifting rates, some are dropping rates. So you may just get caught out by being with the wrong bank.
Oh, 100%. But also, big things there to consider there. All those different lenders there of 25 are all going to have different benchmarks as far as servicing, so as far as across a portfolio, tweaking potential lenders or going with one or the other potentially allow you to buy an additional property.
Absolutely.
Yeah.
So, and that's not just that's just not the the bank itself and you personally. It can even be products within your portfolio, whether you're doing something in your super fund, profile of your property, just so many little elements that people really should take the time to. And like I said, the best way to leverage that, I think, is to get a great broker that really does invest in understanding what's going to be the best products for you moving forward.
Yeah, what a time, eh? What a time.
Crazy. Yeah. Look, one little exercise that I did for an investor that had a principal and interest loan for their family home. It was over $1 million, but they also had a few properties in their portfolio. Using the current interest rate cut and refinancing, they were saving just on the family home nearly $23,000 a year. Across their portfolio, a total of $91,000 a year in savings.
Really?
Just by reviewing, not going off their past interest rates into new interest rates. Now, over the course, now this will all change, but we know that there is some certainty available to investors over the next 3 or 4 years via the products that I'm kind of starting to, kind of focus a little bit on in this podcast. But, around about $400,000 worth of savings over that period of time, which of course we'd always suggest pump that back into that family home loan. Get rid of that family home loan as quick as possible. If you're not doing that, in interest rates like we're seeing at the moment, but there's a few other takeouts. I think it's important to get a couple of takeouts from this sort of, content. Like you said, mate, I'd say stop and review your current loans.
These sort of rates, if you're talking people in their strategy that may be looking to retire in 10, 15 years, call it 10 years, and at that strategy, if you've got 5, 7 properties, you might be thinking, I'm going to sell down 3 and pay off debt. But with rates like this, I'd imagine they're all with that many in your portfolio and the gains that have been made over the last few years, that strategy may change.
Absolutely.
So the strategy of maybe selling down the portfolio when you're borrowing money at these rates, that certainly changes your strategy for your retirement.
Absolutely, particularly if you set up a portfolio 10 years ago and you're now looking at
you're
what
paying
the
capital gains tax if you're selling down properties. I mean, that's why a strategy is so important.
It is. It really is. Yeah. Look, I'd say shop around, use a broker. Don't just stick with one bank. Your bank may be a great bank. I've got one core bank. I do predominantly, I deal with the National Australia Bank. They've been great to me, but I don't just exclusively use the National Australia Bank.
I hope they're not listening, but I'm not a fan of the banks.
Yeah. Well, not many of us are, right? It's never really. I was telling my son about it. 3 generations dealing with that same branch in my country kind of background, and they're thinking there's going to have a value. No, it has no value.
No, you're just a number. You're just a number.
It has no value. It used to once upon a time. At least it felt that way, but not today. Yeah. Look, get finance ready as soon as possible. I'd say to investors, I'm doing it again myself at the moment. I've just gone back and said, look, let's get finance ready again. Value up my properties. Have a look at my portfolio. Tweak and adjust my loans. Test my ability. I'm looking to gear up on some new investments. Just like anyone else, I've got to get finance ready. Yeah. Got to do the exercise first. Otherwise, you start shopping. You and I are looking at projects together at the moment. We're looking at stuff, and we're kind of probably on one we looked at just recently got gazumped, got beaten to the market because somebody else put in an unconditional offer, right? Yeah. It happens, right? It happened to me on the last acreage I was looking at myself too. Unconditional offer. And as soon as that happens, you go, that's a trump card, because I really was hoping to get 30 or 60 days to secure the property, work through it, check the finance, etc. But this market is moving too quick. Yeah. You've got to be finance ready, right?
100%.
Got to be finance ready.
And mate, this has prompted me to just check, if anything, just check the rates.
Yeah. Mate, you'll save money straight away.
Yeah, that's right.
I used to own fitness centres, and one of the best fitness centre operators, he said, you guys are all worried about making money. He said, for every dollar you're trying to make, he said, I'm saving 3 over here. And saving 3 is as good as making 3, right?
Yeah, that's
so
right, yeah.
really smart operator he was. Yeah. Set the bar high. One of the big things I'd say to the listeners is set the bar high. Even though interest rates are so great, the numbers look so good, prices are moving, there's still forecasts as at least 20% growth in the market. That's at least 100 grand on average to most investors they're going to put in their pocket by the end of 2022. But the mistake you could make is that a lot of average properties, even poor properties, look pretty good because of interest rates at the moment. You've got to set the bar much higher. We think that a few $100s a week positive cash flow on 100% finance is a pretty typical experience we go for at the moment. Please be aware of that. And then, like I said, that positive cash flow, guys, this is a chance, I think, to not just build wealth, it's a chance to actually reduce debt. So I think that's a big takeout. Hope you've, I hope we're going to see nothing but, sort of full steam ahead for the property market and the investors that are going to be able to enter.
It's no question it's happening. It's happening, and it's going to continue to happen. It's whether people can get ready for it and get on the train. Yeah,
and if stock's going to make itself available. You personally think in the next couple of months you're going to start seeing a bit of opening of land supply and a bit more opportunity?
Yeah, I honestly do. Although when I have had conversation like I did last night, maybe I'm not as confident. But I think we'll start to see some A-grade opportunities in those owner-occupier estates. Well, I mean, we're getting them now. Granted, we've got to work hard for them. But it's all good news, really, for the investor. Bloody hell.
Mate, I think it is too. I think it is. So long as they stop, they do they get the emotion out of it. They let the numbers do the work and, get well prepared before they just jump in. Thanks for joining me, mate.
Good on you, mate.
Hope you got something out of that, listeners. We'll talk again real soon. Thanks for watching, guys. Don't forget to subscribe, and also feel free to leave me a question. I look forward to helping as many property investors as possible. Take care, and we'll talk soon.